Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Costco Wholesale Corporation, ticker symbol COSTS. We'll be using their recent FY25 10K and earnings data, the AIM, to synthesize a crystal-clear investment thesis tailored specifically for you, the listener. We have a massive amount of data to unpack here. We're talking the financial geometry of their membership model, the philosophy behind that famous $1.50 hot dog, and also some pretty serious legal headwinds that are really testing their premium status.
Indeed. And our mission really is to cut through all that disclosure, all the noise, and deliver the essential, actionable takeaway for you. The core thesis on Costco, well, it's straightforward, but it's also got nuance. Costco is, without doubt, a financially robust entity. It has what we term an immutable competitive moat, and that's built squarely on, extraordinary membership loyalty and some deep operational discipline.
Okay, that sounds incredibly strong.
It is. But the primary investment tension, the real crux of it, lies in the stock valuation. It's extreme. Currently trading at an astonishing 52 times earnings.
52 times. Wow.
Yeah. And this valuation, well, it's what you'd call priced beyond perfection. It implies absolutely zero margin for error in their execution.
Priced beyond perfection. That's a fantastic way to frame this whole deep dive, because when you see a number like 52x PE, you immediately have to ask, right? What competitive advantage is so strong, so predictable, that the market gives it that kind of premium?
Exactly.
And it all seems to start with that membership model, which is, essentially a high-margin, super predictable subscription business running alongside a massive low-margin retail operation. Let's maybe unpack that financial engine first. Membership fee income, MFI.
Right, the MFI. That machine is performing brilliantly. It's actually showing accelerating strength. For fiscal year 2025, membership fee income came in at $5.32 billion.
$5.32 billion, just from fees.
It's from fees. And that's not just a big number. It represents a very healthy 10% increase year over year. I mean, put it this way. If Costco sold absolutely nothing but memberships, it would still be one of the largest subscription companies in the world.
Okay, a 10% increase is impressive. But we have to remember, right, the membership fee increase kicked in September 2024. So was this growth just, charging existing members more? Or is the foundation, the actual member base, truly growing organically? That distinction feels critical for justifying that premium.
That is absolutely the most crucial distinction. And the data, thankfully, supports the strength of the underlying model. Our sources clearly indicate that organic member growth, so new people joining, existing members upgrading that, accounted for about 60%. 60%, that $5.32 billion MFI growth.
So the majority.
The majority. The fee increase itself, while obviously helpful and anticipated, made up only about 40%. So this really signals that the main growth driver is still the structural expansion of the membership base itself. It proves the value proposition is, well, still magnetic.
And within that base, you've got the gold standard, the executive tier members. These folks pay twice the standard fee, but the data shows they're the real engine, right? The financial lifeblood of the whole thing. They don't just spend more. They kind of subsidize the entire model.
The concentration of value in that executive tier, it's truly unique in modern retail. I can't think of many parallels. Executive members right now total about 38.7 million people. That's 47.7% of total paid members, so just under half.
Okay, almost half.
But here's the critical concentration number. They account for a whopping 74.2% of worldwide sales.
74%.
Yeah.
From less than half the members.
Exactly. This demographic, they use their executive status to maximize that 2% annual reward. So it leads them to concentrate their high-value, high-frequency purchases, tires, groceries, but also big stuff like appliances, travel almost exclusively at Costco.
74% of sales from less than half the base. Okay, that concentration implies immense strength, obviously. But maybe, is there an overlooked risk there? I mean, if we hit a really serious economic downturn and those high-value members decide, okay, I need to save $65 a year, and they downgrade from executive to Gold Star, what impact does that concentration risk have on the model?
That is the core vulnerability, you're right to point it out. However, Costco seems very aware of this and is actively working to mitigate it. How? By reinforcing the value proposition specifically for that tier. They're tackling the biggest pain point, really, in the warehouse experience. The crowds, the checkout lines.
Oh, these shopping hours.
Exactly. Effective in September, they rolled out new exclusive shopping hours. just for executive members. And management has already reported this perk led to a, quote, meaningful increase in upgrades from Gold Star to Executive. And get this, it's credited with adding about 1% to weekly U.S. comparable sales already.
Wow, just from that change.
Just from that change. It's a beautifully simple feedback loop, isn't it? More expensive perks drive that high margin fee income, which then funds the lower prices and better service that keeps everyone happy.
And the ultimate measure of loyalty, I guess, isn't just how many new people sign up, but how many actually stick around year after year. What's the renewal rate look like in their core mature markets?
That U.S. and Canada renewal rate, it's secured at an exceptional 92.3%.
92.3%.
Yeah. To put that into perspective for you, that level of annual loyalty, you usually see that with tech services that are like deeply embedded in your daily life. Think cloud storage, key professional software. This is a physical retailer achieving that. It's remarkable. Now, the worldwide renewal rate did see a marginal dip down to 89.8%. But management accurately notes this is mostly due to the mix, particularly new members joining digitally, who historically just renew at a slightly lower rate initially. But 92.3% retention in the core market, that is the definition of stickiness.
So, okay, the loyalty is definitely secured. But how do they afford it? How do they keep prices so famously low while paying what we know are industry-leading wages and still generate the returns needed? That kind of brings us to their operational discipline, doesn't it? Which feels like the ethical commitment almost that justifies that loyalty. Their whole strategy is built on operating at significantly lower gross margins than pretty much all their competitors.
That operational discipline, it's enforced by these strict self-imposed rules, the famous markup caps. They cap branded items at a 14% markup, maximum, and their own private label, Kirkland signature items, at 15%. This is a deliberate, strategic choice to basically forego short-term profit. They call it their pricing authority. The member just knows instinctively if they buy it at Costco, it's going to be the best possible price. And that knowledge, that trust, that is the real moat.
And nothing embodies that commitment to price like, regardless of the cost, more than the hot dog parable. It's more than just a cheap lunch, isn't it? It's really a story about their entire operating philosophy and how management thinks about controlling the supply chain.
Oh, it's the ultimate strategic loss leader, for sure. That $1.50 hot dog combo price point, it's been absolutely immutable since 1985. And we all know the famous anecdote, right? When the former CEO apparently told the founder, Jim Sinegal, that the combo was losing money and suggested raising the price. Sinegal reportedly said, if you raise the price of the effing hot dog, I will kill you. Figure it out.
Right. So they had to figure it out by essentially taking control of the entire supply chain for hot dogs.
Exactly. The solution was massive scale combined with vertical integration. Instead of just relying on outside suppliers, which exposes you to price volatility, they built their own dedicated hot dog manufacturing facilities. Now, that was a huge strategic capital investment, right? All focused on controlling cost and quality over the long term. And the scale today is just staggering. In FY25 alone, they sold over 245 million hot dog combos.
245 million hot dogs. And the rotisserie chicken's the other big one, right? Over 157 million sold in the same year, often sold well below what it cost them. These products aren't really manufactured for profit margin at all. They're there to generate traffic, anchor that perception of value, and make that $65 or $130 membership fee feel like an immediate bargain. And this whole philosophy, it seems to lead us directly to the next pillar, operational excellence, but achieved through, well, radical simplicity.
Efficiency through constraint, that's their mantra. And it's the engine that really enables those low prices. They carry just a tiny fraction of the items you'd find in other big retailers. I mean, think about it. A Walmart Supercenter or a Target might carry, what, 100,000 unique items, maybe more?
Right, easily.
A typical Costco warehouse carries less than 4,000 active SKUs. Less than 4,000.
That limited assortment, what you call the intelligent loss of sales, it seems counterintuitive, but you're saying it grants them immense power.
It gives them immense purchasing leverage. It's simple logic. When you only stock, say, 3 brands of ketchup, you can demand the absolute best price and terms from those 3 suppliers because the sales volume you offer them is just massive. And that simplicity also dramatically reduces their operating complexity, right? Fewer inventory issues, faster stocking, simpler logistics all around. It's a competitive advantage that many retailers just can't replicate because it requires the courage to say no to most products out there.
And key to maximizing the margins they do get is the power of their private label, Kirkland signature. That seems to be their primary defense against inflation and margin pressures these days.
Absolutely. The penetration of Kirkland's signature, or KS, is growing aggressively. KS items consistently offer, 15 to 20% better value than the national brand alternative sitting right next to them. And its rising penetration was specifically cited as a contributor to their Q4 gross margin improvement. They're using KS very strategically now to mitigate external costs, sometimes even on a regional level. Like there was an example where they managed to source Kirkland's signature ultra clean laundry products locally in Asia, specifically for that Asian market.
Okay.
And that move resulted in a massive 40% price reduction for members over there. So they're leveraging their own brand equity to solve specific supply chain issues, region by region.
And this commitment to value, it extends inward too, which brings us to what you called the talent moat.
It's easy to just dismiss high wages as a cost, right? But maybe it's actually an investment in productivity and retention that ultimately supports that lofty 52x PE valuation.
I think this is perhaps the most underrated yet absolutely essential component of the whole investment thesis. The company clearly places human capital as a high priority. It's right there in their code of ethics. Take care of our employees.
And look at the data. The retail industry average for employee turnover is often, 50%, 60% annually, sometimes higher.
Yeah, it's incredibly high. Costly, too.
Exactly. Costco is essentially solving that turnover problem, which, as you say, costs other retailers billions in constant hiring and training. Their U.S. and Canada retention rate for employees with 1 year or more of service is approximately 94%.
94%. That's loyalty.
It's incredible loyalty, and it's clearly driven by their compensation structure. The average hourly rate for their U.S. and Canadian hourly employees hit approximately $32 per hour at the end of 2025. $32. And remember, they raised the starting wage to at least $20 back in March 2025.
Okay, so that kind of commitment to compensation, it obviously increases the selling, general, and administrative expenses of the SG&A line. Did management successfully offset that pressure on the bottom line?
They did, largely. While the investment in wages naturally increased the raw SG&A expense number, management successfully minimized the negative impact through productivity gains and strong sales leverage. The argument here, really, is that the higher wage creates this virtuous cycle. You have happy, well-paid, experienced employees. They provide superior customer service that drives member satisfaction and sales frequency, which ultimately leverages that fixed SG&A cost base. It seems to be paying for itself through efficiency.
Okay, so all this operational strength, it clearly requires massive financial muscle to back it all up. Let's maybe pivot to the balance sheet, which sources accurately describe as a financial fortress. How strong is their ability to self-fund all this continued aggressive growth?
They possess, exceptional financial flexibility. It's really quite remarkable. At the end of FY25, their cash and cash equivalents totaled $14.161 billion.
$14 billion in cash.
And if you include short-term investments, that figure climbs to approximately $15.2 billion, $15.2 billion in readily available funds. Now, compare that commanding cash position to their long-term debt, which, excluding the current portion, stands at only $5.713 billion.
Okay, so we're talking about a net cash position, cash minus long-term debt of roughly $9.5 billion. Give or take. They could basically wipe out all their long-term debt tomorrow and still have billions left over. That level of liquidity, it means they operate from a position of, profound competitive strength.
It absolutely does. It allows them to fund their really aggressive CapEx plans without needing to tap debt markets or dilute shareholders. And those expansion plans are substantial. They remain committed to continuous physical growth, even in a world that's supposedly shifting entirely digital.
How aggressive is that physical footprint expansion looking globally for the upcoming year, FY26?
It's very aggressive. The plan for fiscal 2026 is to open 35 new warehouses. That translates to about 30 net new locations globally once you account for any relocations, and this continues their crucial global diversification strategy. They're pushing into key emerging markets like Korea, but also still expanding in developed markets like Sweden.
And the sheer amount of capital expenditures, the CapEx number, that confirms this commitment, right?
It does. Capital expenditures hit $5.5 billion in FY25. For FY26, the plan is for CapEx to grow even further, potentially landing somewhere in the range of $6.0 billion to $6.5 billion. And management pointedly noted they are growing CapEx at a faster rate than their expected sales growth rate. That signals genuine conviction in their long-term capacity expansion strategy. It's not just maintenance CapEx.
Right. And where specifically is that enormous capital investment being directed? It can't just be new stores, can it?
No, it's really a multi-pronged approach. First, remodels are a huge focus. They're tackling their existing U.S. warehouses, which, believe it or not, average around 20 years old now, so bringing them up to modern standards, improving the shopping experience. Second, land purchases for future sites. They often secure prime locations years in advance. And third, critically, they're investing heavily in their own manufacturing facilities. Things like a new coffee roasting facility, expanding that hot dog production we talked about, and others. All designed to bolster that Kirkland signature value proposition and control costs internally.
Okay, so beyond the physical store, we're also seeing significant acceleration on the digital front, which management is now describing less as just e-commerce and more as digitally enabled sales.
Yeah, that phrasing is quite intentional. It encompasses sales where the digital experience either facilitated the purchase or was integral to the fulfillment. So that includes Costco travel, their partnerships with Instacart, plus their own direct e-commerce operations. That whole category totaled more than $27 billion in FY25. $27 billion. They're really trying to blend the two experiences now, using digital tools to enhance the actual in-store trip. For instance, they mentioned their app feature that lets members check local item availability before they even leave the house that had over 43 million visits in just a single quarter.
Wow.
Yeah, it's about minimizing the friction of that physical shopping trip, making it more efficient for the member.
And this commitment to the member experience, it leads to a really fascinating, almost unique operational policy they call strategic cannibalization. Can you explain that?
Yeah, this is a perfect example of their long-term mindset, really. Strategic cannibalization is the intentional decision to open a brand new warehouse very close to an existing one that's maybe high volume but also highly overcrowded.
Okay, that's like it would just steal sales from the old store.
It does initially,
Yeah.
but the goal is actually to relieve the pressure on that existing overcrowded location, improve the shopping experience for members at both sites, and ultimately capture more incremental sales across the entire local market, even if the new store immediately dings the sales comps of the old one.
And they're actually transparent about the cost of doing this. That seems rare.
Extremely rare. They openly acknowledge that this strategy resulted in a quantifiable negative impact, about negative 60 basis points on total company comparable sales back in September 2025. They are willing to accept a short-term sales dip at one location because they believe it captures more overall incremental sales and improves long-term loyalty and retention across the entire local market. That takes an incredible amount of conviction in your long-term compounding power to make decisions like that.
That long-term conviction is definitely impressive. But it brings us squarely to the counter thesis, doesn't it? When a stock is, as you said, priced beyond perfection, any operational hiccup, any external risk, it just gets magnified immensely. So we need to pivot now and really dig into the operational and legal headwinds that genuinely test that high valuation. Let's maybe start with the persistent macroeconomic pressures.
Right. Inflation remains that constant, quiet enemy for any retailer, especially one based on value. Overall inflation in the fourth quarter, it remained in the low to mid single-digit range. Manageable, perhaps. But critically, they noted that non-food inflation returned, driven primarily by imported items. And that puts direct pressure on their merchandise costs, especially for things they import for, say, the holiday season.
And that rising cost of goods, it required them to take a specific financial accounting charge that acts as an indicator of inventory cost, increases the LIFO charge.
Correct. The return of inflation necessitated a pretty significant $142 million LIFO charge for the full fiscal year 2025. Just to briefly clarify LIFO for listeners last in, first out, it's an accounting method where your latest, usually most expensive inventory costs are matched against your sales revenue first. So this charge is essentially an accounting reflection of those rising inventory costs. It means basically they spent $142 million more replacing old stock than they initially accounted for when that stock was first valued.
Okay. And then there's the whole geopolitical landscape, which introduces risks, specifically around tariffs and sourcing concentration.
Yeah, despite management adopting what they termed a very offensive approach to tariffs, things like consolidating sourcing, aggressively changing item assortments to avoid tariffs that remain exposed, items imported directly from China still represent about 8% of total U.S. sales. So they remain vulnerable to any flux in trade policy, which could directly impact their ability to maintain that strict 14% markup cap philosophy on branded goods.
Beyond tariffs, the business itself, just structurally, has significant geographic concentration risk, doesn't it?
Mm-hmm.
I mean, while they are expanding globally, where does the bulk of their revenue still actually reside?
Overwhelmingly in North America. A really significant 86% of total sales are derived from the highly mature, highly competitive US and Canada segments. And furthermore, their operational and administrative centralization, a lot of the brains are in key areas like California and Washington state that poses an unmitigated risk to critical operations from, catastrophic events like major earthquakes. It's a real, if hopefully remote, consideration for any long-term investor.
And the market, especially with this valuation, is hypersensitive to any sign of deceleration, right? Most recent comparable sales data apparently caused analysts to immediately raise some concerns.
That is the perfection tax in action, exactly. The raw U.S. comparable sales growth figure slowed to 5.1% in September. Now, 5.1% growth in isolation, that sounds pretty solid for a mature retailer.
Right.
But analysts immediately flag this as a serious point of scrutiny. Why? Because when you trade at 52 times earnings, the market isn't pricing in solid, it's pricing in perfect. So any slowdown in the core U.S. market, especially when competition is fierce, creates this narrative of deceleration. And that's exactly the kind of perceived imperfection that can cause a premium price stock like Costco to stumble, even if the underlying business is still healthy.
Okay, and finally, we absolutely must devote sufficient time to the legal and regulatory risks that were outlined in the 10K. These don't sound like just routine boilerplate risks. They seem like high-profile cases that could impact both the balance sheet and, maybe more importantly, member confidence.
Yeah, there are three prominent areas of litigation that really demand attention here. First, they are facing ongoing defense against numerous consolidated cases related to opioid distribution claims. This is part of that large multi-district litigation, MDL number 2804. It's a substantial industry-wide issue with potentially massive financial penalties down the line.
Okay, that's serious. Second, the investigation concerning prescription claims.
Right. They're currently under investigation by the U.S. Attorney's Office concerning claims relating to prescription medications under the False Claims Act. Now, this type of government inquiry suggests a potentially higher level of regulatory scrutiny regarding their pharmacy practices. And the pharmacy is a major part of the overall value proposition for many members.
And third, the very modern risk, privacy litigation, tied directly to their digital acceleration efforts.
This one is perhaps the most direct potential threat to member confidence, I'd argue. There are multiple class action suits pending in both Washington and California. They allege privacy law violations stemming from the use of pixel trackers on Costco.com. These trackers allegedly capture user activity without adequate consent. And significantly, in a consolidated complaint, the court denied Costco's motion to dismiss in substantial part back in November 2024.
Okay, so the case is proceeding.
That denial signals that this is an ongoing and material legal risk. It's related not just to data security, but potentially, more importantly, to a loss of member confidence if the perception of privacy and trust gets compromised. That's core to their brand.
So, okay, we circle all the way back to the central tension we established right at the beginning. You've got this exceptional, culturally resilient company facing real material risks, all set against an undeniably extreme valuation. Does the undeniable world-class performance ultimately justify that magnificent price tag?
The valuation barrier, it really remains the single biggest difficulty for investors looking at Costco today. The stock trades at an extreme 52 times earnings. It is, as we said, priced beyond perfection. And what that implies is that management must flawlessly execute its growth plans, its defensive strategies, indefinitely, with basically no slip-ups in comparable sales, no unexpected margin pressure.
Right, so let's try and synthesize the bull versus bear cases based on everything we've just discussed.
Okay, the bull case, it rests on that enduring resilience we talked about. The rock-solid, predictable $5.32 billion in membership fee income. The financial fortress balance sheet. This is fundamentally a perpetual cash-generating machine with an undeniable deep moat. The bears, or maybe just a more cautious analyst, they point directly to that extreme PE ratio and what they might term the deceleration tax. While consensus forecasts project an 11.2% EPS compound annual growth rate through fiscal year 2027, which, let's be clear, is a solid return.
11% is good, yeah.
It is good, but it's notably slower than Costco's historical peak growth rates. So the high valuation means your future returns rely almost entirely on the disciplined execution of that 11.2% growth. You're not really banking on the hope of multiple expansion because a multiple is already arguably maxed out.
So the final verdict then, for you, the listener, we have a world-class compounder, absolutely. But the price demands nothing less than perfection.
The company is, unequivocally, a world-class compounder. The moat is undeniably strong, deeply rooted in that employee-first culture, the unwavering commitment to customer value, and its immense financial strength. The decision for you, the investor, is really whether that immense long-term compounding power, justified by its core principles and that projected 11.2% EPS AGR, whether that sufficiently compensates you for paying the present perfection tax valuation and taking on the associated risk of volatility if growth stutters even slightly. It's a magnificent business, trading at a magnificent price. And that right there is the heart of the dilemma.
That high valuation leaves absolutely, as you said, no room for error. But I think really understanding the depth of their cultural commitment, it does help frame why the market might be willing to pay such an extreme premium. It feels like a trust premium, maybe, not just a purely financial one.
I think that's a very insightful way to put it. It is a trust premium. It fundamentally stems from an operational philosophy that, somewhat counterintuitively in today's world, prioritizes employees and customers over hitting short-term quarterly profit numbers. And that kind of trust, well, it's built over decades, not quarters.
Which leads us perfectly into our final provocative thought for you, the listener. We've talked a lot about the enduring strength of the Costco culture, that 94% retention rate, the founder's obsession with value. But let's put that philosophy to the ultimate stress test: extreme economic pressure. Think back with us, if you will, to the absolute depths of the 2008 financial crisis, a moment when, the entire global financial system was seizing up.
Yeah, a truly brutal time. Companies across basically every sector were just slashing capital expenditure, freezing wages, entering deep survival mode purely to protect liquidity.
Right. And in that environment, Costco deliberately chose a radically different path. They actually gave their employees a planned significant raise. And at the same time, they lowered prices for customers. They intentionally risked short-term earnings at the worst possible moment. They essentially went on the offensive while almost every other major retailer was purely defensive.
It was absolutely a conscious and undoubtedly costly decision, made specifically to solidify long-term loyalty and protect that crucial talent moat from cracking under what was truly generational economic pressure. They essentially bought long-term trust with short-term dollars.
So here's the question we want you to ponder. If a company's premium valuation today is partly justified by that deep, long-term ethical foundation, that trust, how many other major companies, especially in the retail space, do you think would have had both the sheer financial strength, remember that $15 billion cash buffer, and the profound conviction to give a significant raise to their entire workforce during a generational economic crisis like 2008? That enduring commitment first to its people, then to its customers. Maybe that is the real intangible asset that truly underpins the whole valuation debate today.
Something to certainly chew on as you consider the inherent risks and the potential rewards here. Until our next deep dive.
Risk defined, portfolio protected.